So it's going to be my marketing predictions for Monday, April 13th, 2020. So kind of like, let's see what's going on right now in the world. As you guys see that the Fed just pumped another couple trillion into the market. And now the grand total is above almost close to $9 trillion that we've put in. That's astronomical, man. That's like literally 40% of our national debt that just been increased. And yeah, it's a little bit scary, man. And this market's going up. If you looked at my other video that I posted just before this, explaining PE, there and a lot of you guys already know this, but the guys that don't, there's a ratio. It's called the PE. You know the Shiller ratio, and this just kind of gives you a market price of like where like how expensive the market is today. And on average, the PEs have been 15 for the market. We're now approaching 26 with this bump. And I think with this increase of stocks do end up going up, you're going to get higher and higher. So what does that mean? What does the PE means? It means how much you're willing to pay, how much dollars you're willing to pay per $1, right? In a sense. So a PE of 26 of the market, that's very expensive. That means you're willing to pay $26 to earn a dollar in earnings. On average, it's been at 15 over the course of the last 100 years. On the low end, it's been 5. On the high end, it's been 44. But moreover than that, let's look at a bigger picture here, right? So essentially, what's really going to diminish things here? What happens is inflation, right? So what is inflation? We talked about that earlier too, but it's just when your purchasing power goes down and things get more expensive, right? And who gets hurt is people that have been saving. They're working their tails off. They're trying to do the right thing. If you got like $10,000 put away, and you wake up this time next year, and all of a sudden, a bag of hot Cheetos costs $5, a gallon of milk costs $10, a gallon of gas costs $10. You're like, yo, what the hell? Your wages are not going to be able to keep up if inflation creeps its head. And to me, that's the bigger fear now. It's not just, and the Fed has a hard job. They're trying to keep everything afloat, but you can only keep that genie of inflation bottled up for so long before you do have an incident where there's so much money out there and there's so much lending out there that your dollar isn't really worth anything. And what happens is things get more expensive. It gets tougher on the average guy to go about their daily life, and it's like, so what can you do to protect yourself, right? Everyone says, oh, that's not going to make stocks or bonds really worth anything. You got to be in gold and hard assets and silver. I mean, in a sense, because all those things are doing too is it's protecting your purchasing power. At the end of the day, that's all you want to do is be able to protect your purchasing power, right? So if you were able to buy a bag of Cheetos for $1, in 10 years, you still want that dollar to buy you that bag of Cheetos, or at least buy you something to eat. You know what I mean? You don't want that bag of Cheetos in 10 years from now to be worth $10. So that's why you put money in gold. That's why you put money in certain things, because it's not so much that it's going to make you a lot of money. It's just, dude, you're like, dude, I've worked so hard for this cash. I want to be able to protect my ability to be able to use this cash to buy the things I need to buy. So, but at the same time, like, I mean, I understand the rush to gold or the rush to other like hard assets like silver or whatever. But at the same time, I mean, you got to think about a bigger picture than just that shortcoming. So look at the bigger picture, right? So let's say inflation does happen. Okay, so what's going to happen? Well, uh, prices are going to get more expensive. You're going to see meat, dairy, cheese, everything get more expensive. So there's the CPI, which is the Consumer Price Index, which is like a basket of goods, right? It's like bread and water and whatever the heck it is in that, whatever it is, you're going to see that rise. You're going to see, gas prices most likely, everything rise, right? So what happens if you were to buy gold? Well, then gold would rise also in monetary value, right? If you bought gold at $1,000, it would probably hypothetically go to like 1,500, 2,000, whatever it is to keep up with inflation. But eventually everything got to neutral out. So then you'd be able to sell that gold and then still go buy a hard asset, still go buy real estate, still go buy stocks, go buy something. Because at the end of the day, you need your asset to be productive. You could buy a piece of gold, unless like me, you wear a couple of chains or whatever. If you have a brick of gold, what are you going to do every day? Just dust it and just look at it? It's not being productive. Versus when you have a productive asset, if you have something like, stock in a company, that's producing things, that's selling things, and it's constantly making you money and is constantly growing, that's what you ultimately want. Or you own a farm, or you own a piece of real estate and the rents are going up, and you know what I mean? You want something productive. But gold in the short term, it will protect your buying power if you don't know what the heck to buy and you don't want to lose your ability, right? So it's like if you would have bought gold and you're sitting with $10,000 in cash and inflation goes through the roof, you just have to be able to hold on. You have to not be able to spend that 10 grand because eventually things would come back down and that's when you're going to get a steal on things. But if you don't have something, if it stays there and everything around you gets expensive, then you have to dip into your savings, which is like that 10 grand, and you're going to have to start spending out of it just to maintain your regular life. And that's where people get hurt. But the bigger picture, so after this happens, what can we do? What can we do to combat inflation? Let's say inflation goes wild, because we all can't survive like that, right? Everyone can't just go dip into their savings and mortgage their future to survive right now. So the government's got to step in and solve that problem. So what happens with that? Well, you have to contract the money supply. So you want to make something worth more. It's just like Yeezys, Hermes purses, Gucci belts, whatever the hell it is out there. Money is no different. The less of something it is, the more valuable it becomes. It's just the way it is. If you see everybody rocking like a Gucci belt, or you see everybody rocking a Hermes bag, or you see everyone rocking like a Rolex, Rolex is not going to be valuable. It's just not. It's just a psychological thing. And it's also, it's just the way things work. Same thing happened with Yeezys. You know, you got all these Yeezys out there, all of a sudden Yeezys go down in value versus you keep the supply limited. It keeps it keeps its value. That's on the psychological front, but you have to contract the money supply. It would have to happen in a short wave before it opens back up. And then number two, the most important thing, the number one way to combat inflation is going to be to raise interest rates. Okay, so you raise interest rates. What are you talking, 1-2%? No, you're probably going to have to raise those suckers like 15-18%. And I know those are staggering numbers. You're like, yo, get the hell out of here. There's no way. All you have to do is Google late 1980s and see what happens when inflation started hitting here. So what happens when inflation gets hit? Okay, well, majority of the business loans that are, well, first off, when our interest rates go up, it's going to attract foreign dollars because our investments become, you actually want to place money here because you're going to earn money on interest, right? So what happens is all these people that bought properties, or all these people that bought houses or complexes or farms, or bought businesses, and they got these low interest loans, they have to pay those back every 3 to 5 years. It's a revolving credit, right? Because you have to refinance, because it's not fixed. It's not like when you own a house, it's 30 years flat, you get that price. They're adjustable. So when they go back to re-up and all of a sudden they're facing, 10, 15, 18% interest rates, things are going to get bad. But you're like, why would we do that? Because that's the only way to be able to keep everything else down. Eventually, someone's going to have to lose. And I think we're living in a magical time right now where we think that we can have it all and we're never going to lose. That's just not the way the world works. We can't just make everybody, you just can't make everybody a millionaire and just say, okay, well, you don't have to go home, or you don't have to go to work. You could stay home and you're going to be able to get a Ferrari, and you're going to be able, or you'll get a Toyota, you'll get food, you'll get everything. Don't worry about it. We are just not at that level in society yet. Do I personally believe one day we will be? Yeah, I think so. I think autonomization and just the total production of a capitalist society eventually will be able to take care of an X number of its population. And that's why you see countries like, those European countries that like Sweden and all those guys, that they could pay, to take care of a lot of the needs for their countrymen, is because their population is not that high and they're producing more than whatever, But for us, we're not there yet, guys, and someone's going to have to pay for all this money that we're printing right now. And I'm afraid to say, I think it's going to be the American people at the end. And the only thing America really has going for it right now is the American dollar is almighty, right? Because it's safe. But how long is that going to be the world's reserve currency, right? Because everything right now, like if you want to buy, oil, you got to trade it in dollars in order to get it. But that's a luxury that was afforded to us because we used to be responsible, with our money, and we used to be responsible with our debt. Unfortunately, it's not the case anymore. And if the world investors lose confidence in America, then we will be in a pain of hurt. And I wouldn't know what would happen if we ended up defaulting on our debt. I think the dollar would probably lose its standing in the world in a sense. But I do feel that inflation's coming. And I'm not saying to go buy gold or anything like that. I'm just telling you, if you have cash, you should hold on, because if you could hold on past that inflation, you're going to get a lot of great values. It's going to have to be a huge reset. Everything's going to have to reset to what the actual price is, because not everyone's going to have cash. Because once those interest rates go up to combat the inflation, then things are going to have to come back to normal prices where normal people could afford things, right? Or asset prices at least. But also for, your Doritos bag of chips, right? If interest rates go up, you know what I mean? And Frito-Lay, which is Yum Foods, whatever, they end up having to, it's going to take a cycle, but if they end up having to produce these bags of chips or whatever, all of a sudden, if interest rates go up, the dollar's worth more, there's less dollars, right? They're going to have to charge less to move that product, but the dollar is going to be worth more. I know it's a backwards way of thinking, but just follow with me. And with that, because the interest rates are so high on dollars and dollars are not going to be easy to get, that $1 you own is not worth a lot more than it was when inflation was running rampant. So things would get cheaper. So the average person on average wages could get back to normal, but business people would be hurting. But then that's a dirty cycle, because when businesses are laying off people, you're going to be jobless. So then we're going to have to come back in to reflate the bubble again by doing it. And guys, this whole boom bust thing, it happens because we're freaking human. Humans will always act irrational until the day we die. Until we merge with robots and we could take stupidity out of us, we're always going to act irrational. And that's just, bubbles only happen because we act irrational. And that is like the X factor in the market and in investing and in life that will never go anywhere. I mean, we're always going to say, well, yeah, we could buy it right now. We'll be fine later. And investing, all you got to be successful, in my humble opinion, is you look at something. It could be a house. It could be a stock. It could be a bond. It could be a farm. It could be anything. You'd say, you know what? I think the value of this is this because this. And you stick to that. Don't change that and say, if you were wanting to buy a 1-unit house, like a regular family home, and you're going to rent it out for $1,000, I would pay $100,000 because I would earn, $10,000 a year after property tax, whatever. And, I would earn all my money back in 10 years. If someone says, hey, pay $110,000 for it, okay, that's an extra year. Then someone says, I'll pay $120,000, and then see how things get. And then someone's like, oh, well, rents will grow, this will go, that, and you get away from the fundamental of your evaluation. And that's when you start paying more and bubbles start getting inflated, and then things come crashing down. The biggest lesson I could tell anybody is, when you're investing in something, is just have your own opinion and form it on your own, your own thoughts, your own merit, your own work, your own thesis, and tell yourself, why is this not going to work? Answer that question, right? You're like, oh, this won't work because X, Y, Z. And then compare that to why you wrote down why it will work. And you got to just use your common knowledge and be like, you know what? I know why it could not work. I know why it could work. And I'm going to decide this because of everything I've took into it. And that's really all it is. And we get a little bit crazy because we start, worrying and thinking and everything gets kind of, just lost. And you're like, Jesus, like, what do I do? But sometimes you got to just take a breath and just say, this is what it's worth because this is what I feel it's worth. And you got to go with your gut in that sense. But like, we'll see this week what happens as more jobs reports come out, as earnings are upon us. But I have a feeling that by this time next year, if we keep printing, inflation will rear its ugly head, and we will have to face that. And that will be a whole different can of worms that we open up. But hey, I'm interested in seeing what your guys' thoughts are. And I don't know, leave a comment if you have anything or your thoughts and opinions about where we might head. Maybe why I might be wrong. I'm interested in that too. I probably damn near could be. Everything could end up being fine. But yeah, if you liked it, share this with at least one friend. Help me grow the page. Thanks for listening.